Okay, today we're going to spend some time breaking down what order flow is. This seems to be the flavor of the month as of late. So we're going to take this as an opportunity to not only dispel some of the common misconceptions, but just make sure everybody has a good foundational understanding of all the core components. So hopefully by the end of this video, everybody will have a better understanding of how to interpret and how to apply this sort of information. Without further ado, let's go ahead and dive straight into it. Okay, so what is order flow? Order flow is the analysis of market orders and the liquidity of a given market. So most order flow analysis will be displaying the market order data. However, we must always respect the fact that every trade that goes through a market is going to be one-to-one, where the market order is matched up with the passive limit order. So let's go over a couple of key definitions that are going to be important for later in the video. First off is going to be volume. So volume is going to be the record of how many total contracts have been traded. Next is going to be delta. Delta is the ask volume minus the bid volume. A more simple way of putting that would be the market sells minus the market buys. We use this generally to gauge how much effort is being put in by takers. Next is going to be cumulative volume delta, which is commonly abbreviated as CVD. This is when we take the delta and we have a cumulative sum over a specific time period. The default is going to be daily. And then lastly, we have open interest, which is going to be the record of how many total contracts are open for a derivative. So a simple example for this would be if you go and market buy 1 Bitcoin on the major Bitcoin perp, you've now increased the open interest by 1. Okay, here we're going to be going over the core order types that are going through markets so we can better identify the two main participants that we're monitoring when we're using order flow data. This is really important for the segments that will follow, so make sure you have a decent grasp of this. So the two participants that we're monitoring are going to be the makers and the takers. So the makers are going to be the market makers. These are the guys that are going to be providing liquidity, and they're going to be using passive orders. So they're going to be using limit buys or bids or limit sells or asks or offers. The other participant is going to be the taker. These are the guys that are market buying or market selling. Understanding these two order types is incredibly important because this is basically the key foundational component of how we're interpreting flow. Okay, so let's spend a little bit more time and focus in on the passive and aggressive participants here, because this is going to be probably the most important piece that you understand. If you don't understand this stuff, none of the stuff later on will make any sense. So diving into it, as we've already established, there's the two core participants, makers and takers. It will be a little bit easier for most of you if you just think about them as the people generating market orders versus the people that are generating limit orders. The makers will be quoting the spread and they make the market. So literally they make the market work. That's why we call them market makers. And the takers are the people that aggressively come and take liquidity from them. So generally speaking, the passive orders are more likely to win out in the long run. And this is because they just have a far greater chance at coming from the heavier hand, which will be the liquidity providers and the smarter traders. And to reiterate how important this is, understanding this relationship between these two participants is the key piece of understanding everything that I'm going to teach later on in this video. So in the future, whenever you struggle with some of the more complicated topics, always come back to this core concept of we're watching the relationship between the takers and the makers, and that's literally everything comes back to this every time. Okay, let's go over liquidity. So what is liquidity? This is a term that you're going to hear used all the time, and a lot of the time it's used improperly. The simple definition is that these are the resting orders inside of the book. These are going to be placed by the market makers or liquidity providers. Let's take a moment here to dispel a quick common misconception around market makers. So the market maker is not evil. He's not out here hunting your stop, all that classic stuff that you see on social media. Market makers aren't moving price. They're simply facilitating trades by providing liquidity when you, the aggressor, is impulsively aping in and out of your positions. So I like to think of the market maker a little bit more like a coworker. They're in the game for themselves to make money, so they're not your friend, but they do facilitate your trades. When you are impatient and need to take liquidity, they're there for you. So they're not evil. This is a really common misconception. The people that are running your stops you should think of them as the more advanced traders, but they're definitely not the liquidity providers. So keep in mind that when the market maker does a worse job, it really hurts you in a large way, and the key way that will be is through slippage. So you want the market maker to be there, and you want him to do a good job, because it allows you to get in and out of your positions in an aggressive way and avoid slippage. The last part is to keep it in mind, as I prefaced at the beginning of this, is that the market makers, the providers, they're in the game for themselves, right? So it's not their job to always quote in a way that is going to work for you. Their job is to quote in a way that is going to benefit them. So you need to keep that in mind. And these guys are basically profiting from quoting the spreads, and when everybody is impatient and it aggressively takes, that's how these guys profit. Okay, so here we have all the common tools and indicators related to flow. We'll be going everything in greater detail later in the video, but I'd like to do a quick primer on everything before we do so. So to start off, we have CVD, or Cumulative Volume Delta. That's pictured here in the middle of the screen at the bottom. I generally use this indicator for a simple way to identify absorption. Next, we have footprint. This is my favorite way to actually read the flow of the market that I'm trading. I think it's the most effective way because it records everything for you, and it's not strenuous to absorb the information like the next option. The ladder or depth of market. This is the most effective way to read the flow of the market, but is also the most tiresome, as the amount of data points that you're going to get fed is substantially larger than the footprint. So I generally recommend the print to most people earlier on, just because it's so much easier to digest. Next, we're going to have open interest. So open interest is the indicator that we use to identify when people are opening and closing positions. This is really, really important for my lower time frame trading. Next is going to be the volume profile. Volume profile is generally used for bias formation and having a general idea of what style of trading I should be deploying. Next, we're going to have Vwap. This has over time become my favorite tool just because of how much it simplifies my trading. So Vwap is a very, very great tool. That is also pictured on this middle screen here, Vwap with standard deviation bands. And the last thing that we'll be going over is time and sales, or tape reading. This is personally one of my least favorite methods, although it does have its use cases, so we'll be touching on that. For more information, check out the Paragon group with the link below, where I cover everything from how I trade to how you can develop your own style. Okay, going over CVD, or Cumulative Volume Delta. CVD is the cumulative sum of delta throughout the day, so it's basically an aggregate from the takers throughout the day. I generally will run these charts on time or volume based. When it's time, it's going to be something like a 5 or a 15 minute. When it's volume based, it's going to be something to roughly mimic a 5-minute time frame. I'm using this tool to identify absorption in a very, very simple and reliable way. Basically, we're looking for regular divergences, similar to how we would see regular price action divergences, where our price is diverging from our oscillator. So what that's going to look like is in these pictures that we have on the right, we have two different bull divs, both of which price is either making a higher low or an equal low, and the CVD is making a lower low. What this is telling us is that the passive bid is absorbing, and once that sell side pressure starts to get unwound, the div starts to play out, and this is a really great intraday or slightly higher time frame approach. I don't generally use this for scalping as much, as I think that CVD divs end up taking quite a long time to play out. This is definitely going to be much more in line with your intraday style of trading. Okay, let's go through some quick CVD examples now. We're going to be using examples from the recent price action from this morning and from last night. So first off, let's go over the New York session bull div that I was stalking. It's playing out quite nicely. So following an aggressive sell-off, we trade into the composite and value area low from the day overlap. Following that is where the div begins. We can see that price is slowly making higher highs on lower time frame, while the CVD is making consecutive lower lows and continuing to trade down. This is showing us that the passive bid is absorbing all this sell pressure. So once we get this final wick down, that's when the div really locks in, and we can see that momentum clearly shifts as a lot of that sell pressure begins to be unwound. The other thing that we can be looking for confluence other than the levels is in the delta profile, so we can see the very obvious delta nodes. So basically we can just see that it doesn't matter if it was longs closing or shorts opening at the end of the day. This is a lot of aggressive delta into the lows amidst a bull trend, so this is a classic bull div setup. There was a couple others to go over. I wanted to touch on this one over here. This isn't your most standard textbook div, but it does play out very, very nicely, so it's important to point these out. We can see that price comes down, makes a low, makes a significantly higher low following that and is reclaiming the daily VWAP. And we can see that CVD is clearly making a lower low when that's happening. So what happens is you get the daily open and you get an aggressive pop off the daily open. You get a little bit of selling, you reclaim the daily VWAP, and then you run it up as a lot of that delta is unwound. So basically, what we're seeing with the CVD divs is that we're seeing the line in the sand getting drawn by the passive participant, and then eventually the aggressive participants start to get squeezed out and then unwind their trades, and that's how these CVD divs play out so cleanly for us. Okay, getting focused on the footprint here. The footprint is without a doubt my favorite tool. It's the one that I'm using the most consistently, regardless of whether I'm doing intraday trading or scalping. This is almost always going to be one of the key tools that I'm using for Confluence. So what is a footprint? A footprint is essentially a record of all the market activity. So this records it all for you in a very nice and convenient way, and it's very easy to read. So going over some of the anatomy, the way that footprints are going to be set up is going to be very different. There's lots and lots of different ways to set them up, but one thing that's always going to be consistent is going to be the footprint stats. So pictured at the bottom, we have all the stats aggregated for each candle. So we can see the CVD throughout the day, the delta for the individual candle, the delta percentage, and then the total volume. Every footprint is going to have a record of this. This is going to be something that you will have to choose to turn on. But this is almost always going to be a default thing that we're going to be running alongside our footprints, just to have a very clear record of all the information in front of us. The next two things to go over are going to be the profiles. So all my footprints that I use, I'm going to be using both a volume profile and a delta profile. This is showing me where the volume is taking place per tick, and then is showing what's happening with the aggressors, whether you have more buyers or more sellers. This is a very key piece of how I use the print, because the nodes are almost always going to be providing very strong confluence in my decision making. Okay, zooming in and looking at the footprint a little bit in some more detail. Here we can actually see a live print that's trading. I just wanted to go over a couple of things here. So first of all, with my footprints, generally speaking, I recommend running time-based earlier on, and as you get more advanced, you want to probably switch to non-time-based. Either some sort of trend reversal style candle or volume based. These are going to be volume based. I also use tick based. That is probably the most common one that I use, is that's going to be the number of trades that go through the market. So every X amount of trades, you're going to get a new candle printed. Again, this one is going to be based off of volume. So every 10 million lots that go through on this main perp market, we're going to be printing a new candle. So I'm using this tool primarily to, like I said, identify where a lot of the volume is being traded, and then seeing in the individual candles where the volume is taking place. There's lots of different footprint setups to be using. Obviously, the most common one that everybody should be familiar with is absorption. But there's a lot of other versions, like exhaustion and initiation and failed auctions, etc. So I'll be going over all those in separate things. Okay, let's go over the ladder or depth of market, commonly abbreviated as DOM, D-O-M. This is definitely one of my favorite tools when I'm scalping. I use this a lot. It has two main use cases. First of which is going to be order execution. So for lower time frame, this tool allows me to easily place passive orders either close to the spread or far away, and then very quickly shuffle through my position sizing. So this is one of the primary ways that I'm doing execution with scalping, is using this tool, because, to reiterate, it allows me to very easily place orders into the book, and it also allows me to very easily shuffle order size very quickly. Order execution is going to be very easy to learn how to do. There's not much of a learning curve. With analysis, though, which is the other main use case, this is where this tool gets a little bit more tricky. So we should think of the ladder very similarly to how we think of a footprint. The only difference is that the amount of information we're going to see in the DOM is significantly higher. So a footprint will aggregate a lot of the information together over time and kind of clump it together, whereas the DOM is going to have a much more granular representation of this information. So for scalping purposes, it gives a lot more active and useful information. But the thing is that it's very difficult to learn how to read, because when you first look at it, this is just a screenshot that we're seeing, but when you look at a live DOM, it's moving very, very fast. All these orders are constantly changing and repopulating, and it can be a little bit overwhelming at first. So just take the ladder with a grain of salt and acknowledge that you don't have to use it for analysis at the beginning. It is very strong with the use case of execution, and over time you'll become more and more comfortable with it as you use it, And I do think that it's one of the most effective ways to get a read on the passive and aggressive flows that are going through your market. Okay, let's go over open interest. So what is OI? OI, simply put, tells us how much open value there is on a given derivative contract. So the simple way to explain that is going to be if you go and trade the standard Bitcoin perp that everybody trades and you go market buy 1 Bitcoin, you have now increased the total open interest by the value of 1 Bitcoin. It's important that we know that whenever positions are opened, they're always 1-to-1 because the open interest is just recorded in the taker, but you have to know that the maker is always on the other side of the trade. So when 1 Bitcoin worth of positive delta is market opened, that 1 Bitcoin of negative delta is passively opened. So let's look at the quick schematic up here at the top. This is generally speaking going to be correct. The key point I have to make with this is that with open interest, using the lowest time frame option is going to give you the most accuracy. If you aggregate time together and you're looking at an hourly and a 4-hour or anything like that, your idea of positioning is very heavily skewed and inaccurate at that point. But the simple rules are if price is going up and open interest is going up, that tells you that longs are opening. If price is going up and open interest is going down, that tells you that shorts are closing. If price is going down and OI is going down, that tells you that shorts are opening. If price goes down and OI goes down, that tells you that longs are closing. This is the classic rule that you can generally apply because it's almost always going to be correct. But I really want to make the point that we require some nuance when reading open interest, because if you just simply look at a 15-minute time frame and say price is going up over an hour and OI is going up, so it's clearly all longs opening, you're probably not going to be actually accurate when you're doing it that way. So zooming in to either low time frame or even this is where this real spice is, ideally non-time based OI. This is where you're going to actually get a realistic representation of positions opening and closing. This is a core element of how I do all my flow trading. Sure, having a lot of delta can be useful, but knowing if that delta is opens or closes is even more useful. Okay, here we've got a very popular flow tool. This is going to be volume profile, commonly referred to as volume by price. This is simply going to be showing us how much volume was traded at each individual price point, so we can see where the majority of the volume is taking place within the visible price. So this is going to be primarily used for identifying the range and for level confluence. So this is a very effective tool for identifying what fair value is, and then we can use the whole acceptance or rejection of that fair value as individual trade theses. Some of the things that we're looking for are going to be high volume nodes. So pictured below at 16 and change, this would be considered a high volume node because it's the volume node that is the largest out of the entire price range. In high volume, we expect balance, so we expect rotational nature price action. Next, we have low volume nodes, so around 1880 and change. This would be considered a low volume node, where this is some of the least volume that's being traded in the entire development that we're looking at. With low volume, we expect imbalance, so we expect more trend style price action in these areas. So it doesn't matter if you use this for higher time frame or lower time frame. All these rules are going to be exactly the same, whether you're scalping a 1-second chart or you're trading a 1-week chart. How we view HVNs and LVNs is going to be exactly the same. Okay, diving into Vwap, or the volume weighted average price. This is without a doubt one of my favorite tools for structuring trade theses. This is very effective whether it's for swing trading, intraday trading, or scalping. It doesn't matter. All the rules essentially are the same. I'm using this tool for both mean reversion and momentum strategies. The different types of Vwaps to pay attention to are going to be anchored. This is where you pick a swing point and you choose where your Vwap begins. This is one style that I will use. And then the time-based are the main ones that I'm going to be using. So they will reset every X amount of time. So daily, weekly, monthly, quarterly, and yearly. This is a very effective tool for setting up and structuring theses. It will even provide you very clear invalidations, in my opinion. So for bias formation, we're looking at over-under. So is price above or below? What is the slope of the Vwap? And then what is the actual price structuring around these pivot points on the Vwap? Those 3 core tenets right there are basically enough for structuring a thesis, whether it's for a scalp or whether it's for a swing trade. I find this tool to be very effective, and as time goes on, it just becomes a more and more essential part of how I trade. Okay, let's tackle tape rating. So what is the tape? Tape is the record of all the incoming market orders coming into the given market that you're following. The common name for this tool is going to be referred to as time in sales. So what does it actually mean to read the tape? So essentially you're looking at a tool like the tool we have here on the screen to actually watch all the market orders coming in, and you're going to be looking for simple order flow setups like where is exhaustion beginning, where is absorption taking place, etc., etc. I don't think that this is the most effective tool. I think it's good for when we're learning and familiarizing ourselves with flows, but I would consider this to be my least favorite tool, simply because it's just very tiresome. The amount of energy that you have to put into actually making decisions around all this information. Just from this screenshot, we can very quickly see that over a 5-minute period, all these orders came through. Over a 5-minute period, over a 2-minute period, all these orders came through. So essentially, when you're tape rating, you're trying to beat Rain Man basically, and have an understanding of how much orders or how many orders on each side, buy and sell, are coming through the market, and trying to gauge when the aggressors are exhausting and when the passive players are absorbing. I really want to reiterate the point that I think that things like the footprint or even the ladder are just going to be so much less energy consuming and thus more efficient. I think it's much more of a min-max approach to use a footprint, but I'll digress from that. The pictured above is the Agar V3 tape. When I do read tape, which is very rarely, I'm going to be using Agar for it. Okay, what platforms can we use to gain access to this information? So I'm only going to go over platforms that I've used and am familiar with myself. But let's go ahead and get into it. So first off is going to be Sierra Charts. This is the core flow tool that I'm using these days. I love the customization options. Sierra Charts will give me everything except for open interest information, so it's almost my all-in-one shop. Next is going to be Exo Charts. I use Exo Charts primarily when I'm traveling, for just charting majors basically and getting simple prints. Exo Charts is very easy to use and is very user friendly. I think Sierra Charts is a better platform, but Exo is better when you're newer. Coinalyze is where I'm going to be pulling my open interest data. Nowadays you can import the Coinalyze data into TradingView. So a lot of times I'm just going to be using TradingView instead of Coinalyze, but Coinalyze is where the data is getting sourced from. Next is going to be CryptoWatch. I really like CryptoWatch just because of how lightweight and fast the program is. It's got to be without a doubt the lightest weight software out of all the flow stuff I've ever used, that is actually an app that you download. So from CryptoWatch, things like tick charts, I use it a lot for depth of market and for tape myself. The last one will be Agar. You can type Agar into Google and it will pop up. Agar is a web-based flow customization platform, so you can go in and write simple scripts. And I don't really use Agar that much these days, but if I was, I would be using it for tape and for reading deltas or for reading CVDs. But yeah, Agar is pretty great. So these are all the ones that I use myself. There's lots of other platforms that exist. I just have very little familiarity with any of them, so I don't want to promote any of the ones that I haven't used a lot myself. All these platforms are very good and reliable, and I use all of them pretty consistently. I'd say Exo is probably the one that I use the least consistent, and that's just simply because Sierra kind of replaces it for myself.